I have some great news for investors out there regarding several stocks, and because of what these stocks have basically reported, it's going to affect several other stocks, and we're going to have a little bit of a domino effect here. So I need to run you guys through what's going on now, what stocks are likely going to boom in this situation, and run you through all that at the beginning of this video, okay? Once we get through that, there's 3 videos I want to react to in this one here today. The first one up here is we like dry powder, says this man. He says he likes dry powder, so we're going to go ahead, react to that one. I want to share my opinions and perspectives on that one. Market sentiment could be a threat to the bull market in early 2025, so looking forward to reacting to that one. And then last one up here, everybody's favorite bull, Tom Lee, went on CNBC this morning, spoke about kind of what he expects to happen here in the market, in the financial market. So looking forward to reacting to that one, sharing my opinions and perspectives as always. Okay, busy day for me here today, folks. Appreciate you joining me. All I ask from you guys in return for doing this video here today is a thumbs up. All you can do is smash that thumbs up button for me. I appreciate y'all. I appreciate the 10% of people that do that. And to the 90%, I wish you would just smash for me, but I understand it's too much to ask, okay? Also, I appreciate everybody subscribed to the channel. New all-time high subscribers in the history of this channel. Pin comment down there today. If you're looking to apply to join my private stock group, apply to join that. Get access to all my premium courses, Discord chat, moves I'm making, all that good stuff. That will be pinned comment down there, okay? So, what do we have going on? Well, we have some big things, folks, and this is going to affect several stocks that we're going to speak about right now, okay? So, here's what happened. Ulta Beauty came out after the bell. They reported basically earnings per share that was ahead of where analysts were at. Now, for me personally, I don't own Ulta stock, so I don't really care about that. However, if anybody's watching this that owns Ulta stock, be ready. Ulta stock's likely going up, quite substantially. So that's good news for them, right? What I care more about is revenue of Ulta. And the reason I do is because I have major bets on Elf Beauty, ELF stock, and Estee Lauder, EL stock, right? 2 cosmetics, beauty-related companies. And so I want to see Ulta's revenues be ahead of where they're supposed to be. So Ulta Beauty reported revenues that beat by $30 million. So that's a good sign, right? A lot of people were fearful it's going to be worse than expected. Instead, it came in better than expected. Comp store sales increased 0.6%. Obviously, net income was very good for the company, which once again, I don't really care about because I don't own Ulta stock personally. But if you own Ulta stock personally, like that's good news for you as well. Now, maybe even more important was right here the outlook. So their prior fiscal year 2024 net sales outlook was 11 billion, 11.2 billion. Now they updated to 11.1 billion to 11.2 billion. Now you might say, well, what's the big deal with that? Isn't it kind of in the same range? No. Because basically they brought up their bottom range. So now worst case scenario they see is $11.1 billion of revenue, which means they're probably seeing closer to this number of $11.2 billion, realistic here. So that's really good news. Additionally, comp store sales, they were expecting negative 2% to 0%. Now they're expecting negative 1% to 0%. Also, so basically, the business is trending better than had been anticipated in regards to beauty. So that's good news, once again, for Elf, for Estee Lauder, for those sorts of companies. And certainly it's good news for Ulta. Now it's also good news for the consumer in kind of this is like the early signs that the consumer is starting to get in a better spot. This is like very early signals, I would say to that. Additionally, another company came out that if you want to look at the consumer and how the consumer is doing, you always pay attention to Lululemon. I think it's another important company, right? Lululemon delivers solid quarterly results. Lululemon delivered solid quarterly results, lifting shares higher in after-hours trading after better than expected profit and sales. The double-digit comparable sales growth in international markets. So that's good that international markets is getting in a better place. Because remember, a lot of people think going through inflation, you think like if you live in the United States, like you're the only one that went through inflation over the last several years, right? Or if you live in Europe, you think, oh, I'm the only one that... No. Everybody went through big inflation over the last several years. In 21, 22, 23, everybody went through inflation. It wasn't like it was just certain countries. No, everybody got hit. Some countries got hit much harder than other countries, right? Lululemon earned a profit of $287. Up from $1.96 a year ago. As I don't own Lululemon stock, so I don't care about that. That means nothing to me. But if you own Lululemon stock, this is very good for you. What I care more about is revenue. So revenue increased 9% to the company, 9% for the company. That's $40 million above analyst estimates. So that's good news there. Comp sales in the U.S. fell 2% from the same quarter last year, but that was offset by a 25% surge in international sales. So the U.S. looks like it should come back in 2025 and flip positive again there, but international is starting to come back very strong. So this is good news for companies that do business international, and this is also even bigger news for any consumer-related companies. If you own any of the sort of stocks that are B2C type plays, I think those companies are starting to position very well for 2025 and beyond, specifically 2025 and 2026, right? And here's why. Let me show you exactly what's going on here. So what I'm showing you right now is United States wages and salary growth, right? So we've been trending around 5% range here recently, right? But meanwhile, CPI has been trending in the 2s. So we actually have real wage growth that is going to help the consumer out substantially next year, right? And honestly, the consumer needs that help because the consumer got leveled. 2020, it really started in 2021. People act like the inflation didn't start in 2022. No, it started in 2021. The consumer got leveled 2021, 2022, 2023 when it came to inflation. Finally, it's alleviated in 2024. You've seen a lot of consumer companies this year get hit bad. A lot of numbers bad for these companies, right? A lot of companies reporting down revenues, flatlining revenues, right? Heck, Lululemon, when Lululemon has negative comp store sales, you know it's rough for the consumer out there. There's no other way to put it. When you have companies like Nike reporting tough numbers, like, Estee Lauder, like you just go through a long list of them, Ulta. When you have all those companies reporting bad numbers, the consumer's they went through it, right? But the good news is the consumer's emerging out. We're getting the early telltale signs that we're likely going to have a consumer recovery, which likely is going to bode very well for consumer-related stocks in 2025 and 2026. So you could see a lot of money rotate into those as the stories get much better. And I think that will also give a lot more comfortableness in the market in general. And the reason being is, when you see those consumer names also rallying good numbers out of those, it makes people feel like the economy's better. When all these big multinational companies are having trouble even showing growth, it doesn't give the best feeling about the economy being strong, right? So good news overall. And once again, I think this is based upon Ulta's and Lululemon's results there. I think it's early indications that this is going to bode well for a lot of stocks that I've been buying here recently. I'm just going to be honest with you guys. A lot of these stocks I've been positioning into, I think they're going to end up being great plays over this next, I would say, we can call it 2 years. Something like Honest comes to mind, Revolve comes to mind, right? Nike comes to mind. Shopify's been putting up great numbers, so Shopify can really put them in that category. I think this even bodes well for like a PayPal in 2025. I think this bodes well for EL stock, for Cheesecake Factory stock. I think this bodes well for Elf stock. So there's a lot of those consumer-related companies that I think are going to, do very well based upon what we're seeing here overall. So now I made some videos here recently. Not sure if you guys got to see these on the main channel, Financial Education. This one's 6 stocks to buy and hold forever. I just released that one on the main channel 3 hours ago. And this one I released 2 days ago. 5 stocks I'm buying now, December 2024 edition. So yeah, if you guys haven't gotten to check out those videos, you might want to check out those a little later, okay? Alrighty guys, so let's go ahead and react to some videos here. They should be fun, including our man Tom Lee, everybody's favorite bull.
It's good to see you again. You were walking up and I said, hey, what's up? And you said, everything.
That's right.
It literally.
Yes, that's true.
Does it keep going?
Well,
not everything's up. It's just not factual, right? You can get the impression that everything's up, but it's just not the reality. I was even looking at some of the meme stocks recently, just trying to see, have people been buying those sorts of stocks? No, they haven't. So, yeah, Bitcoin's doing really good, right? Palantir's doing really good. Tesla's doing really good. Some of those really famous stocks in the Mag 7s have done pretty well, some better than others, right? But you look beneath that surface and you see a lot of damaged, bad value stocks, dividend stocks that have been doing a whole lot of nothing or going down, right? And so, yeah, that's something to keep in mind.
Right. I mean, Trump is inheriting an economy, both a market economy, so the Wall Street economy looks good. Obviously, we're talking everything's up. The Main Street economy looks good. It's softening, but from a very high place. And I think with all the animal spirits we've been seeing in the last, post the election, we may not even land. There's no landing, right? That's
kind of been in that scenario for a while now, thinking, yeah. Right? Forget the soft landing. This looks to be a no landing economy. When you have the Fed chair yesterday himself using the word remarkable.
And that's been our call.
The economy,
Scott. That was our call, right? I said that earlier. I don't think the Fed's going to cut. Things look too strong to me. I mean, and they cut a little bit, but maybe they pause. But inflation's in a good place. Liquidity is amazing. Everyone said when they start cutting rates, we're going to see all this money flow out of money markets. It's up. So yeah, everything's up. That's all good. The setup's up good. So the credit guy's still bullish.
Yeah.
And now, Mr. President, just don't screw it up.
What do you mean by that? Like, how could it get screwed up?
Well, the valuations are high everywhere, right? So who really wants to own it at this price, right? I think that's the reason why you have so much dry powder out there. We like dry powder. I think that's one of our themes. Take a page out of Buffett's book. It's not a bad page. He's much larger than we are, but if you can sit in CLO AAA and earn 5, 5.5, 6, 7, 8, whatever it is. I mean, this year is for us going to be closer to 8, but that's going to be much better than T-bills. But that's safe, inflation protected, volatility protected. Rate vol takes off when you get it.
I don't know about this whole CLO stuff, but what I will say is, you can say, yeah, you can make 4 or 5% being on the sideline. True, right? And you say, it's good, man. You're making money over there, and I have cash over there and making good money on that. But the S&P 500's up like, what is the S&P 500 up this year? 25%, 30%, something like that, right? You're wrecked versus just being invested in the index fund, right? You could look at like the returns in the public count this year. If I recall, last time I looked, it was like 60+% in the past year. Like, gosh, I should have probably been even more invested than I was already invested, right? So there's two ways to kind of look at that. And so you got to watch cash levels. It's good to build cash, right? It's good to have cash on the sideline. It's good to have emergency money, all that stuff, right? But you can't go too crazy with it, trying to hope that you're going to be able to perfectly time like a market crash or something like that, because you're just going to be let down many times. And what's going to end up happening is the market's just going to continue to drift higher. And then when you do finally get that downfall, a lot of times the downfall will still be, like the bottom of that will still be above wherever you could have bought in previously. So, and that's painful. That's very, very painful to go through that process.
In the 4 instances in the last 15 years.
And that's why what everybody watching this, what you should be doing with your money. This is what I do with my money, right? I know roughly, I have like a certain amount of money that goes into each portfolio every single week, essentially, right? And you can do this either every single week, you can set this up every 2 weeks, or you can set this up every month. And many brokerages now allow you to do this and easily set this up, right? So what I'll do is every single week, I have $500 deposited into the public account that I invest. I have $250 basically transferred into the Patreon portfolio that I invest. I also have a certain amount of money that goes into my private portfolios every single week. Now, I'll still do some one-off freakish buys here and there, but for the most part, I am buying every single week, and I'm buying a consistent amount. And that saves me from this kind of like worry about like trying to get the perfect timing on the market and this and that. Instead, I just look at the market very evenly and I say, this is opportunities. And everybody that's watching this video right now, you can do exactly what I do. As long as you have more income than expenses. And by the way, if you're watching this right now and you don't have more income than expenses, right now, write down like, I need to figure out how to get more income than expenses, okay? Because that's like a must to be, if you want to be a good investor, like you have to have more income than expenses so you can consistently invest, right? But that will save you from this worry about trying to time it out perfectly and things like that. Instead, sometimes, like if I look at like the quick trip days, those are great days for me investing, building my wealth from nothing into $200,000. And what I did, oh, nice Lamborghini there. What I did consistently is not buy Lamborghinis. I would invest almost as much money as I could every single week. I always kept a little money around for emergency purposes, just in case this happened, that happened. But other than that, I was investing the far majority of my money all the time. And that's what you should be doing over time, right? You're looking at out there, there's always going to be great opportunities in the market. There's never been a year I've ever seen where there weren't great opportunities in the market. Never. It's just there's different opportunities in different years. Sometimes value and dividend stocks are like the best opportunity. Sometimes it's growth stocks. Sometimes it's tech stocks, right? Sometimes it's small caps. Like there's always like a different where the best opportunity is. But since I've been investing, there's never been a year where I haven't seen opportunities. There's opportunities this year. There's going to be opportunities next year. In 2026, there's going to be opportunities 2027, 2028, 2029, 2030, 2031. Go through it all. There's always opportunities out there, okay? And it's up for you as an investor to research those opportunities, figure out where you want to invest, and pounce and take advantage of that, right? And then make a lot of money over the next few years.
A sweep on the hill?
Yeah, you get a lot more rate vol coming out of that because of the things that potentially could go wrong. And all the scenarios are on the table, Scott. stagflation, depression, a recession, a giant peace dividend and another growth and another round of inflation, or hopefully we just stay in this Goldilocks thing, which would be wonderful for me.
I mean, you say, these are the words you gave to our production team. An untethered Trump means all scenarios are possible. Geopolitics, bond vigilantes, rate volatility, deportation, recession, trade war, reflation, meme implosion.
Yeah,
that's a long list.
And they're real. They're all possibilities. They're all possibilities at a time when things are very priced nicely. But do you listen to all that now when nothing has happened and the fundamentals look so good? I don't think so. I think we stay long our credit plays. We stay long our risks that we like. We keep some dry powder.
What are you going to do with the dry powder? Like if you have a growing amount of dry powder, right? You mentioned
it's true.
Buffett and those folks at Berkshire, they're on like a Mount Everest of dry powder. And some are wondering, why do they keep sitting on it? And what are they going to do with it? Maybe valuations are prohibitive to them doing anything with it. So what are you going to do with yours?
Well, for us, right, it's really saying, what is fixed income supposed to do? What is your fixed income allocation supposed to be in a balanced portfolio? It's supposed to be the money you can count on to rotate into risk assets when that happens. Now, it's kind of weird saying that now when we're so bullish, right? But the things that keep us up at night say that at some point, maybe some of this happens. The 15% case is what's priced in now for inflation.
Okay, so before we get into this next video and then the Tom Lee one, let me explain to you guys something very important here, okay? I want to draw your attention to, just in the past 10 years, the amount of times that I heard a lot of talk during certain years about the market was overvalued, the market's very expensive, we're setting up for a downdraft, those sorts of things, okay? I'm not talking like people were predicting necessarily a full-on stock market crash, but just time periods when I remember there was a lot of chatter about the market's rich, like look at the Schiller PE, look at the forward PE on the market, look at the trailing 12-month PE, those sorts of things, okay? So the first time I really heard a lot of that was 2014. There was a lot of people talking about, valuations are stretched, valuations are rich, those sorts of things, okay? Next time I remember hearing a lot of that was right around 2018. 2017, 2018, there was a lot of talk about, because we had a big Trump rally essentially in the market, right? And there was a lot of people that felt like things had gotten overvalued, like, sure, we're getting the corporate tax cuts, but this is kind of extreme, right? The next time period I remember that was 2019. Right? People were kind of arguing maybe the market's a little richly valued. Next time period was kind of the end of 2020 going into 2021. People were arguing the market's rich. Next time was this year, 2024. People are arguing that the market's rich, right? Then you can say, well, some of those times, a year later, 6 months later, 18 months later, you had a drop in the market, you had a correction, you had a crash, something like that, right? Fair. But at the end of the day, throughout all of that, where's the market today, and where was the market in all those time periods when people argued the market was rich, right? And so understand, we could have a major correction in the market in the next 6 months, 12 months, 18 months, right? Could have a crash in the market, like who knows? But at the end of the day, when you look out 5 years from now, 10 years from now, 15 years from now, wherever you were at likely in the market is likely going to be a small amount compared to where the market's going to be in the future, as it's been every single way along the road, right? And I could tell you before that, I got on the market end of 2008 going into 2009. Before my time, there was plenty of times people argue the market's way overvalued. I mean, heck, people were arguing that back when the Nasdaq was 2,000, back when the Nasdaq was 1,500, back when the Nasdaq was 3,000. People were arguing like the Nasdaq's way overvalued. And I'm not saying they were wrong. They might have been right on the short term, but they were wrong over the long term. Absolutely, every single time. Because you're saying the Nasdaq was overvalued at 3,000. Okay, the Nasdaq today is 20,000. You were wrong, right? So you were right, but you were wrong in the end. And that's tough. That's tough for investors to accept. And that's why, at the end of the day, invest consistently in the market, because you're not going to have to play all these mental gymnastics all the time of like, what's the perfect time to buy and all that stuff, because it's a brutal game to play. And most of the time, you're not going to make nearly as much money if you just consistently invested over time. If the market crashes, I'll be just investing heavier. That's the only thing that'll change with me. I'll still be consistently investing. I'll just be investing heavier. We get a major correction in the market, I'll still be investing consistently. I'll just invest heavier. That's the only thing I change. I just amp up my levels of buying, right? 2022, it was buying insanity.
Good to see you again. Welcome back.
Hi, Scott. Thanks for having me.
What else do I need to be, I don't know if wary of is the right way to say it, but what else do you suggest is showing what you think is animal spirits?
Yeah, well, look, that's an important part of a bull market. Obviously, you want to you want to be a part of those animal spirits as they're building. You want to be wary of those animal spirits as they get frothy, and I don't think we're there yet. We can certainly talk about that, but we look at a lot of different aspects of the market. One of those being the IPO index, right? So. How are new issues doing relative to seasoned issues? Because obviously they tend to be more speculative without the track record and the battle scars, if you will. Those are making new highs. That index looks actually really, really impressive to us. Another aspect of this would be high beta versus low beta names, particularly on a sector neutral basis. So even high beta, say, utilities versus low beta utilities are outperforming, and that tends to be good news. And then finally, just to put a pin in it, is cyclicality. The cyclicals are outperforming the defensive names. That tends to be good news historically. So I like the building of the animal spirits. I do think sentiment can be an impediment at some point, but I think that's after the beginning of the year. I think that's sometime probably starting in February or late January. But until we start to see more evidence of that, I think the signposts are still pointing towards this.
A good ratio to keep in mind here, if you want to think about what is too much cash? What if I have too much money on the sideline? A good ratio to think about is what I call 10 to 30%. So ideally you want to kind of be 10 to maybe 30% cash at, depending upon how aggressively you invest in the market. If you ever go over, so let's say your net worth assets versus liabilities is $1 million, for instance, right? And you can just run this math, right? If you ever get to a point where $300,000 of your net worth is in cash, more than 300,000, then you're probably not investing aggressively enough. You're probably need to study a little harder and look a little harder for investment opportunities because you're probably getting way too heavy cash, right? If you're less than 10%, you might be investing a little too aggressively. So let's say you have, only $30,000 of cash, but you have $1 million net worth. You're probably investing a little too aggressively in that situation, right? So unless you're in a major crash at that time or a correction where you're just buying everything you can possibly get your hands on, outside of that rare scenario, like for instance, 2022, I went under 10% cash because I was just buying everything in sight, right? So if you ever in that situation, maybe you can, get away with going under 10%, but usually you want to stay at least around that 10% number, right? So let's run smaller numbers. If you got $100,000 net worth, your assets versus liabilities is $100,000, right? Then if you ever have more than $30,000 in cash, you're probably way too heavy cash. You need to look for investment opportunities. If you have less than $10,000, you might be investing, too aggressively, and you should cash up a little bit in that situation, right? So just some ratios to kind of think about there. But yeah, I mean, if you're in that first $100,000 of building a wealth, though, keep emergency money around, but you want to be investing almost everything in sight. If you have less than $100,000 net worth, that's the way I did it back when I worked at Walgreens, back when I got my first, good job working at Quick Trip as a manager, right? Back in those days, I kept emergency money around, which for me meant, maybe a couple $1,000s or something like that, $2,000, $3,000, which keep in mind, $3,000 back then is nowadays like $5,000, $6,000, $7,000 in today's money, right? But kept some emergency money around for a rainy day, and then boom, everything else, invest. That's how you really climb the ranks. Once your net worth gets bigger and bigger, cash levels become a little bit more important.
Bull market being intact.
And the reason being, you just have a lot more opportunities when you're the wealthier you are, right? If you have a multi-million-dollar net worth, this is kind of getting off subject here, a little higher end type stuff, right? But let's say you have a net worth of multi-million dollars. The amount of investment opportunities you have to you are immense, right? The amount of stocks you have to invest into is everybody, right? Real estate, because you might be acquiring real estate properties if you have a multi-million-dollar net worth, and when you're acquiring those properties, you might be coming out of pocket $100,000, $200,000, $300,000, $400,000, depending upon the price point you're buying and how much you're putting down for those homes, right? It just gets more complicated, right? You might have businesses you're building, you might have investment opportunities in friends' businesses or acquaintances or whatever, right? It's just the world kind of opens up to you, obviously the wealthier you get. And so, naturally you'll keep a little bit more cash on the sidelines, basically the richer you are.
Does it get excessive? Do you have numbers in mind? I mean, you must in certain levels as a technician. What makes you say, okay, now it's getting a little crazy?
Yeah, it's less about levels. Unfortunately, I'd love to give you a hard level. It's really more about the data that we look at. And so, we'll look at the option pricing. We'll look at some of the sentiment survey. And really, for us, what becomes interesting is if the sentiment is out of line versus the historical returns. And so, if we see a lot of bulls, but we really haven't made much price progress in the market, that becomes a dangerous sign. That's not happening here. We're still in good shape. We have about the same number of bulls that we'd expect given the types of returns that we've had over the last couple of months. So I think we're still okay there. But I do suspect, about 65% of our sentiment indicators are flashing some type of warning sign. They usually are early at a top. So, again, I think seasonality is a more important indicator here than those sentiment signals. But it's certainly worth watching, and I think it will be important at some point in time, probably in early 2025.
See, I think one of the reasons it's so tough to get a major correction right now, and when I say major correction, I'm talking S&P 500 goes down over 10%, right? Which that still isn't even a major correction. That's like meh correction, right? It's so dang hard to get that. Why? I'll explain to you why. The reason is everybody wants that. I want that. You guys watching this probably want that. Would you not like to buy stocks 10, 20, 30% lower next year than you're buying them this year? Probably. Unless you're a person that doesn't have more income than expenses. Then you don't have any money to invest in the market and you're like, crap, man, like I'm screwed like if the market goes down, right? But for the majority of you guys watching this video right now, right, you have more income than expenses. So you would love the market to be down next year. I would love the market to be down next year. I don't need to inflate my ego by having my portfolio say a certain amount when I log in. And I'm like, oh man, wow, so big. I'd much rather buy lower and get bigger gains in the future, right? That's just me and you. What about all these Wall Streeters? What about the fact that we got, $7 trillion roughly on the sidelines right now? Do you think all that money's not looking at their yields going down? I swear every day I receive an email from my different companies I have savings accounts through, CD accounts, that they lowered the rate again. They lowered the rate again. You think I'm the only one getting those emails? I think everybody's getting those emails right now that their savings account just went lower, right? That one that was yielding 4% just went down again, right? CD accounts are going lower. Everybody's receiving those emails. So everybody's looking out there like, damn, man, I'm getting squeezed. Like my yield keeps going lower and lower. The market's high. Man, I wish the market would go lower. Everybody wants the market lower. And when everybody really wants the market lower, it's damn tough to get the market lower. You get it? So, that's just something you got to think about. All right, Tom Lee, everybody's favorite bull.
Based on what Taneo was describing with regard to Bitcoin, what do you think that this most recent rally says about the overall risk appetite in the market right now?
Well, it's really telling us investors are pro-risk. I do think it also just signals how much capital has been idle for the last couple of years, either parked in money market cash or waiting to see if the economy survived. So I think Bitcoin rising is to me, breaking out of a holding pattern is a precursor to what the S&P is going to do the rest of the year.
Speaking of the moves in the broader markets, you say the road to 6,300 is paved with bumps. What do you expect investors to see ahead that may slow them down? What are some of the key markers that you're looking for?
Well, I think there's a lot of macro to digest the next 3 weeks. Tomorrow is the jobs report, and I think investors are fearful that it's going to be too strong because of the hurricane and seasonal adjustment, so it's going to be a big number. Next week is CPI, which has been running a little hot, and Fed Chair Powell spoke about that earlier this week. And then, of course, on the 18th is the FOMC rate decision. So I think once we're through these events, investors can actually then invest into sort of that Christmas Santa Claus rally. So I think 6,300 is still very doable.
So you're basically saying don't go away after the 18th because there may be some additional upside toward the end of the year?
Yes, or buy the dips. Yeah.
So, I mean, you suggest there that we're in a bad, good news is bad news for stocks environment. I mean, why should the market be concerned if the Fed is going to be less aggressive in terms of cutting rates?
I think there's a conceptual change that the market has to get used to, which is, let's say earlier this year when the Fed started cutting, people thought, oh, 5 cuts is good for stocks in 2025. So if the number gets reduced, it's bearish. I think as we get into 2025, the market's going to shift to thinking the fewest cuts possible next year is the best case because it elongates the dovish cycle. So I think we have to flip the script, but it's going to take some time.
But hasn't that been the case all year? I mean, because in January of this year, the market was implying 6 or 7 cuts. We're only getting a few. We've slowed the pace.
See, and this is another thing that's so difficult on how to get this market down. It's really damn tough. Here's the thing. I just took you guys through the consumers getting in a better spot. They should likely get in even a better spot in 2025, right? What is the U.S. economy specifically? What does the U.S. economy run on? It runs on the consumer. Anybody that knows anything about economics knows the U.S. economy is the consumer. And so with the consumer getting in a better place, that should bode very well for the overall economy in 2025, right? So it's hard to just bet against the market when that's going on. Additionally, obviously, you're going to have a lot of Trump optimism in the market, right? And additionally, you have the backdrop that the Fed, yeah, maybe they're not going to lower super aggressive, but they're still more leaning toward lowering rates than raising rates, right? So, I mean, those are just all factors you got to consider here that makes it, once again, difficult to get this market down.
2-year yield is not that far below Fed funds anymore. So I guess my point is the market's already kind of registered that slower is better.
That's right. I think it's, I would just say it's not a consensus accepted view because, for instance, when Fed Chair Powell spoke about taking things a little slower, the market got weak and then maybe had a rethink. So I think it's going to take a while until markets realize one cut next year is actually quite bullish.
Are you surprised that equities haven't?
Oh, and dang, I got another thing for you, okay? If that wasn't enough, here's another reason it's hard to get this market lower. We spoke about real estate, being a real estate investor. I'm going to be honest with you guys, real estate investors just are not interested in real estate right now. And the reason being is whatever you buy a home at, in almost every market I look at, in almost every major market, whatever you buy a home at, this is a freak situation, but almost every home you buy, if you calculate, you put 20% down on that, okay? And what a mortgage rate would be for you, right? Basically, you would not be able to make back what your mortgage payment is each month in rent, which means it's completely unattractive for real estate investors out there still. We need real estate to go lower to really start to pull in the real estate investors again to say, you know what, I'm going to put money in real estate. So if you're somebody that's got money and you're looking out there and you say, okay, I can get 4% on a savings account, right? Or I could buy real estate and lose money on my rent versus mortgage each month. Okay, I could do that. Or I could invest in the stock market or Bitcoin. That just keeps going up, right? This is another reason, just one of 1,000 reasons why it's so difficult right now to get this market down. At some point, the market will fall, but it's just, you have just a stack of reasons why it's hard to get this market down. And that's why, the market trades rich, but people are willing to pay because it's the best option you got.
Reacted to some of the political turmoil abroad, South Korea, France, elsewhere?
In some ways, I think the stock market had been already pricing this in because, as you know, this year has been a pretty significant divergence between U.S. versus Europe and U.S. versus emerging markets and even China's sort of failed rally. So I think in some ways the market's not surprised. Maybe it was even pricing in this through currencies and equity prices.
Tom, I'm going to go back a long ways to our long relationship. Do you still even track active managers and how much, they're trailing their bogeys at all, and whether that's a factor in any way at the end of the year?
Yeah, in fact, we've been cleaning up that data because, as you know, in the last 10 years, there's been a big change in the number of managers. It's good. It's kind of a good and bad year because active managers that tactically went cyclical or more offensive or tech have been having banner years. I mean, we have so many clients that are beating their benchmark by 6, 7, 8. These are unheard of outperformance, but it's a small number because, as you know, when you look at the world more towards macro or market neutral, it's been very tough.
Yeah, and that's once again the whole plays into the whole Santa Claus rally thing, right? So just many various factors there. Okay, guys, appreciate you joining me as always. Once again, pin comment down there if you're looking to apply to join my private stock group, get access to all my premium courses like Become a Master Stock Market, Millionaire Playbook, Stock Options Mastery, Dividend Investing Mastery, all those, plus private Discord chat. There'll be pinned comment down there. You can click on that, fill out a form. We'll see if we can get you access to that maybe next weekend or next week at some point in time, right? And additionally, if you haven't got a chance to check out these 2 videos on the main channel yet, you might want to check out those 6 stocks to buy and hold forever. And this one here, 5 stocks I'm buying now, December 2024 edition. Much love and have a great day.